Good afternoon. We're going to talk about Bollingers today. So the first thing I would mention when we talk about what are Bollingers or Bollinger Bands is what a lot of people refer to. They're these little lines that go outside of the price action on a lot of people's charts, outside of the candles. And from there, we're going to talk about what are those, what are they doing, why are they there. So first thing to understand when you're talking about Bollingers is something called a standard deviation bell curve. See, standard deviation bell curve. And overall, what we're looking at is a general spread of, I don't want to say reality, but the idea is that if you had maybe a bucket full of sand and no other resistance whatsoever and just let it all pour out the center of this bucket, you would get a pile that's referred to as a standard deviation curve. And in that pile, you would have 34% on each side of the center. So that gives you 68% inside of what we refer to as the 1 sigma. And then you have out to the 2 sigma, which is the next zone out, 95.4% of all of that sand has fallen into between those two zones at the 2 sigma. And then if you go the next one out, you have the 3 sigma where 99.7% of everything has fallen inside of. If you draw a little barrier, you see 99.7% of everything is inside of it. And then after that, we have a lot of times a 4 sigma that 99.9% of all price action falls inside of, which is a very high range. So picture your 4 sigma a little bit outside of the 3. And you have what is referred to as a standard deviation bell curve. Now, when we have Bollingers on the market, I want you to try and picture this curve, but turned sideways around the market. So same bell curve with 1, 2, 3, and 4, but turned sideways on the market. So you could see how much of the price action falls within those ranges is the idea. So within the 1 sigma Bollinger, 68.2% of the price action will be inside of there. I personally do not have a 1 sigma on my charts, but some people will. After that's 2 sigma. The 2 sigma Bollinger, 95.4% of all of your price action falls inside the 2 sigma. The 3 sigma, same thing, 99.7% of all of your price action is within that line. And then the 4 sigma on the outside, same thing, 99.9, I think it's 99, something like that. Don't quote me on the number, but a large majority of all of your price action is within the 4 sigma Bollinger. That's really the important thing to know. So with that said, we're going to get out of this curve and go look at what do they look like on charts. Are you with me?
Yes. Why don't you had the first?
Really, just because I've never practiced as much with it. Sometimes I know that people see moves that go between the 1 and 2 sigma, but it seems like it's really on the center of the price action. So I can add one really quick. Right now, I have the 2, 3, and 4. For the sake of demonstration, we can add a 1 sigma. So we have the 2, the 3, and the 4. But to me, the 1 sigma is a little bit tight. It doesn't give me as good of a range because by the time I'm at the 2 sigma, again, it was, what is it, 96% of the price action is inside of it, 95.4. So that's a large percentage of the price action. And the 2 sigma has actually become my favorite Bollinger over time because of how much the market respects it. The 1 sigma oftentimes gets broken back and forth, but it can be a very relevant level. So I will add it to my charts as a demonstration as to how you will add your Bollingers. Very good question though. Personally, I just don't trade with it. I had it on for a little bit and it seems like it's a little bit much at times, but I've actually thought about having a separate tab just for Bollingers where I have the 1, 2, 3, and 4 sigma, and that's about all I have, maybe other than 2 main EMAs or something, so it doesn't seem excessive on the charts because I do like the Bollingers and I like how they show a spread in the price action. So let's talk about tendencies of the Bollingers. Did that answer your question? Kind of. We'll go back through it and we'll look at a 1 sigma, and you're welcome to have it on your own charts. So a
Did you
common
add
look,
it?
I'm sorry.
Did you add it?
Let's do it
I'm
now. So
sorry,
I'll
the
just go
chart's
through that
small.
first. We can go through that first. So if I wanted to add Bollingers to my charts, I would go through indicators. So right click, go to indicators. And since I already have the 2, 3, and 4, I'm going to add the 1 sigma the same way you would add the 2, 3, and the 4. So each set of Bollingers, the 2 sigma, 3 sigma, and 4 sigma, are all a separate indicator. So you have to add them individually to have the next line on there. So with my Bollingers, you can see all of my indicators that are configured are on my charts in the bottom left, and you see three different sets of Bollingers. You see, if you see the 2 before the 20, you see a 220, 320, and 420. What that means is that I have a 2 sigma, a 3 sigma, and a 4 sigma, and the 20 is the period that they rely on, meaning they're based off the last 20 candles on the chart. So let's go back through and find, so in order to add a Bollinger, I'll find Bollinger in the list, just says Bollinger. On the available list, click add in the bottom left. From there, go to my properties. So the Bollinger that I have come up comes up as 2 and 20. From there, I want a 1 sigma Bollinger, so I'm going to change that to 1 and 20. Sometimes it'll come up as a period of 14. I'm not sure why that's default for Ninja, but I know that the period of 20 is commonly used by other traders, including Mr. Bollinger himself. The man who designed these Bollinger Bands used a period of 20. So it's very common at FNL as well as other places to use a period of 20. I'm sure there's people who also use the default on the Bollingers as well as other periods, but overall I use a period of 20. So with here, standard deviation 1 means it's the 1 sigma, period of 20, so that's the 2 periods I have to change. That's the 2 parameters I have to change to get the band correct. From there, everything else is visual, so I might change the label to not exist. See where it says label? I might delete that so it doesn't show in the top of my chart. I might undo the price marker, might be checked. You want to make sure that's unchecked because that'll give you a box on the right side of your chart where the Bollinger Band is, and it gets excessive over time. And then upper, middle, and lower band are each band. I'm going to turn these red just so we know which one's the 1 sigma. All my others are green, darkest to lightest from the inside to outside. So this one's just going to be dark red because that's a color I see. We'll be real quick with it. Personally, I like that EMAs and Bollingers are a little bit different on my charts as far as what they look like when they're painted. So I have my EMAs dashed. Any EMA I have will be dashed except for a little tiny 10 EMA that I've added recently. And then the Bollingers I have dotted, so they look a little bit different, stand out, and I can tell at a quick glance whether I'm looking at a Bollinger or a dash. So I hit apply. So once I get it set up how I want to, I change the color of each one under plots. And again, the parameter is 120, hit apply at the bottom. They're all red, and I see that the red Bollinger came up on my charts over there. Awesome. I'm going to go look at the charts. So applied it. We're good.
Wow, that's super narrow.
Yes, it is. It's very, very tight on the price action, and it's not as relevant as a zone. The market's really easy to break it, and it could be a false bias at times if you don't know what you're looking. Meaning, if you looked at the 1 sigma Bollinger and said, "Wow, it's hitting the 1, it has to turn around here," that would be a scary attitude. I think oftentimes the Bollingers become a point of confluence where I'm already looking for a trade, and then the Bollingers help me define exactly where I might find that trade. So that's one way I look at them. I think they're a point of confirmation more so than a reason, the only reason to take a trade. So let's talk about what's happening on the charts with the Bollingers. You see we have our 1 sigma, 2 sigma, 3 sigma, and 4 sigma Bollingers. Sometimes it's easier to see what they do when I scrunch the price action a little bit. You'll see how the Bollingers get wide and skinny and wide and skinny over time. It's a little more common at times to see something like the bubbles we see in the past, where you see it get wide and then skinny and then wide again and then skinny, however you look at it. But oftentimes there's these bubbles over time. If we back up, they're probably a little more pronounced. It's common to see. Yeah, see how they get wide and skinny and wide and skinny? What that tells you is the market's speeding up and slowing down and speeding up and slowing down, almost like the market's breathing as well. So why do the Bollingers paint the way they do? That's really important to understand. First off, on average, they're going in the direction of the trend. So if the market is creeping up, the Bollingers want to go up with the market. Now with this, if the market speeds up, the faster the market is moving in any given direction, the wider the Bollingers get. So if the market is going upwards, but not necessarily rocketing upwards, what you're going to see is the Bollingers on the top moving up with it and the Bollingers on the bottom moving up with it. If the market, however, takes off like a rocket way in the up direction, because I guess it's a ratio, but because it's moving so fast, the top Bollinger will be moving up with it, but the bottom Bollinger will actually start spreading out. And this is actually a common indication to people as a green light to go long because it tells them Not only is the market going up, the market's going up fast enough that the bottom Bollinger is spreading out on the bottom side. So if you ever hear people talking about the Bollingers expanding, that implies that the market is speeding up. And vice versa, if we were going really fast and then we start to slow down a little bit and go a little bit sideways, you'll see the Bollingers that were really wide start to come in and hug that price action again. So what did we just mention? If the market's kind of creeping upward, you'll see the Bollingers on both sides going with it in that direction. If the market speeds up very, very fast, okay, so creeping upward with a general relative size of trend and candle staying the same is one thing to think about. The Bollingers will go up with it on both sides. If the market speeds up really, really, really fast in the upward direction, the Bollingers will expand. On the top side, they will be going up. On the bottom side, they will be going down. And if vice versa, the market was going fast and starts to slow down and kind of pitter out sideways, you'll see the Bollingers that were wide start to squeeze in. So generally speaking, if the Bollingers are expanding, the market is going faster. And if the Bollingers are consolidating or squeezing together, then the market is slowing down. And if you can't tell that they're really expanding or squeezing, they're just kind of following price action, it tells you that whatever trend you have is going about the same speed it's been going. Are you with me?
Yes.
Perfect. If you have any questions at any point, please feel free to chime in. So with that, I can look back at the market and see, okay, well, they're expanding right here, and it was reflective of a big green move upward. So that's one where it was speeding up in the upward direction so fast that the bottom Bollinger was going down. So let's clear everything I've done so I don't look like a child with watercolors. And then you see when the Bollingers are contracting like this, that the market was going really fast and then slowed down and started to go sideways. And as it started to go sideways, the Bollinger squeezed back in, showing you that the market is slowing down. So oftentimes, Bollingers can be reflective of how fast the market is moving relative to how fast it was moving. Like if they're expanding, it tells you the market's moving faster than it was before. And if they're consolidating, it tells you might still be going up, but you're slowing down in your direction. And it's not that it won't keep going. Like in this case, they consolidated and then expanded again, and the market kept going up. So you can't assume it has to turn around just because the market slows down, but they can give you a picture of what's going on with the price action and with the trend. So let's talk about another thing you will look for with Bollingers. Does that make sense though? They're reflective of how fast the market is moving. And
Yes.
also they will go in the direction of the trend unless the market's going so fast that they're expanding. And that's the one time that they won't follow the direction. Or if it's slowing down, they're consolidating together. So on top of that, the Bollingers often create ranges for the market to go between. It's common to see any set of Bollingers become a range. So what do I mean by that? I know the market's really scrunched right now, so bear with me. Let's say we have the 1 sigma Bollinger and then the 2 sigma outside of that, right? It's common to see the market, we'll do the market in pink because I don't know why, but the market oftentimes will bounce between these two levels, between the 1 and 2 if it's going up really, really fast and then maybe come back down. And there's a lot of things to look for. So the bottom 2 sigma, I don't want to draw over price action. Let me start this over. So let's talk about common tendencies. If we have our 1 sigma inside, which I don't usually use, is one thing to think about. I usually have the 2, 3, and the 4 on my charts at this point in time. Not that they're bad, but let's call that the 2 sigma, and this one the 1 sigma. And then the midline of the Bollingers is always the same. Whether you're 1 sigma, 2 sigma, 20 sigma, as long as you have the same period, your midline is a median, so it is the middle and it is always the same. In this case, my midline is gold and it's right in the middle of everything. It's pretty cool to see. So common tendencies. One thing I like to see is that the market will cross all the way from 1 2 sigma line all the way down to the other one and create a channel between the 2 sigma lines. That's a common tendency that if I click on the market, I can almost guarantee you'll see at least a little period of time where we've been between the outside dots. If I expand it a little bit, It's very common to see the market bounce between the two sigma lines, meaning this line right here and the
Is that
bottom
what
line.
Randy refers to in the morning as the range?
No, Randy's range is the first 30 seconds after opening bell. It's where does the
Got
market
it.
go? So if the
Just
market was right here and it
verifying.
went up and up, his opening range would be that after 30 seconds.
Thank you.
You're very welcome. That's there's a few different trading groups that use it. I think PAX is one, but they talk about the first hour box as well as the first 30-second box.
Okay, thanks.
You're very welcome. So back to Bollingers. The range of the Bollingers is often, what am I saying? The market often bounces back and forth in a range of Bollingers, maybe 2 to 2 as it's kind of creeping forward. Overnight, it's a really good time to see that, where it's almost unrealistic how many times you'll see it just 2 to 2 to 2 to 2 back and forth over time. And it's not always predictive. You can see there's times where if I just set a short on the 2 Sigma at 2300, I'd have gotten stopped out by a really huge green candle. So you can't assume it has to turn around just because it hits a Bollinger. But if you're already looking for a turnaround in an area, a Bollinger can be a very good place to see the market stretch to. And then another thing I wanted to mention about common tendencies between Bollingers is they'll give you a relative speed of the market as it's going up. So let's say, sorry, I know I have. So the one is pink, the two is gold, and each one that goes out will be a new Bollinger. So this one will pretend as our 3 sigma. I'm sorry, let me get that line out of the way. Oh, I gotta do my demonstration all over. Goodbye. There it is. Okay, so if I have the 3 sigma on the outside, another common tendency is to see the market run up in a zone. That's what I kind of talked about earlier. So if you have a really fast upward move, you might see it go from the 1 sigma to the 2 sigma, and that might be its range. It might just bounce between that, and that tells you it's pretty fast move, but could be a little faster. Another common look would be to see it go all the way towards the 3. So let's say this is the 3 sigma line. It'll go all the way up to the 3 and then bounce back and forth, either sometimes to the 2 sigma, sometimes the 1, sometimes even the median. So where it retraces to based on the trend, but oftentimes you'll see it just bounce right off that move, and it tells you, wow, that's a 3 sigma speed move. That's a very, very fast move. And I did a poor job because the outside line should not go sideways. Oftentimes they're stretching in the upward direction when you're going fast. So the 3 sigma oftentimes will be up there, and you'll see something a little bit bigger as it speeds up. But if it's going all the way to the 3 sigma, that market is moving rather quickly. And even beyond that, you have your 4 sigma on the far outside of the market, which is often moving really, really fast. And if the market makes it all the way to your 4 sigma, that's an indication of, wow, not only is this trend going up, but it is going up at a very, very, very fast rate. Are you with me there? So it takes more
Yes.
effort for the market to make it out to each Bollinger. It's rather easy to hit the 1 sigma. By the time you go out to the 2 sigma, remember 96% of the price action is inside of that. So once it gets outside of the 2 sigma, let's say there's your 1, the yellow's your 2, yellow, blue, but once it's outside of this range and stays above it, you know that 4% of the time it's out there. So eventually it will come back inside those bands. You might not know exactly when because there's some really fast uptrends that just to the moon, see you later. And if you were assuming it had to come back, you'd be in trouble. But you know in the back of your mind, only 4% of the time is it outside of the 2 sigma. And then you get all the way to the 3 and you get a 1% mark where maybe 1% of the time it's outside of that line. And same thing, you think, wow, that is a really fast move and the market can't sustain that fast of a move. You might not always know when it's going to turn around, but it tells you with reflection that the market doesn't move this fast very often and it's going very, very fast right now. So when might it come back? You can almost anticipate that it can't go that fast forever. And oftentimes when it retraces, a good place to see it retrace to is the median or the other side Bollinger, whether it be the other side 2 sigma or 3 sigma. So a very common look is to see the market after a really, really fast run up. You might see it bounce back right to the midpoint and then continue, and that gives you your place of retracement to continue forward. If we look for that on the market right now, let's hide all of my stuff here. I'm looking for a place again that the market has bounced off of the top and come back to the median Bollinger. And if I look at that center line, you can see, well, I got to pull my paint out to mark it. We could use the Ninja Draw tools. Let's draw a little polygon on it somewhere. So see how, let's find one. All of this area, perfect. So down, down, over here. When we retraced in that area, we kept pulling we kept pulling back to the midpoint of the Bollingers. And I could stretch that a little bit so it's a little easier to see. But see how we're above the Bollingers. So when we hit the 2 sigma, it says we're moving up, but maybe not super duper fast. That's the 2 sigma on either side, and the median's in the middle. So you can see we knocked on the door of the 2 sigma a couple times. So we're moving up, but we can't break outside of the 2 sigma right now. So it's a pretty average uptrend. And then you see we did break out of the uptrend right at 925, or we broke out of the 2 sigma, I mean, right at 925. So once we're getting close to opening bell, it was fast enough to go outside of that 2 sigma area, and that tells you it's a very, very fast move. But the point I wanted to make is each time it retraced here, it came back to the median of the Bollingers. That is a very, very, very common look on the market, and I didn't plan this around today's price action. It just happens to be today's price action that it does come back to the median. I'm sure there's times you could go back in the past and see the same thing where oftentimes you see it run up and then come back to the median. Or another common occurrence on the Bollingers is what people refer to, I'm going to clear my earlier demonstration, what people refer to as a 2 to 2 cross. So in my example, the 2 sigma Bollinger is the dark green, and it's very common to see the market go from one side of the 2 back to the other, and then back and forth. You can see in this case, you could almost connect the dots, almost like ping pong. It literally is just going, that one's kind of close in the middle, debatable, but back to the 2 on the top, and then we're at the median. Median, median, median. So neither one is a 100% of the time it has to do this, but it's a very common tendency to see the market go between the 2 sigma on the top and the 2 sigma on the bottom and bounce back and forth. It becomes a point of confluence at times for many traders to see that we're just back and forth across those levels. So common occurrence on the Bollingers, 2 to 2 cross. You could draw an X, you could draw a cross, a C, whatever you want to call it, but it's what people look for. So are there any questions while I'm here while I stop?
Nope, still absorbing.
Awesome. I know I'm talking rather quickly today. We don't have as much time as other times. I will come back through it. So, generally speaking, the two main points today. The faster the market's moving, if the market is speeding up from its earlier trend, the Bollingers will be expanding. If the market's slowing down, the Bollingers will be consolidating. If the market is moving upward, the Bollingers in general are moving upward, and vice versa. If the market's moving down, the Bollingers in general are moving downward. And then you often see channels that the Bollingers create what many refer to as a dynamic channel, meaning the channel changes over time, but gives you a reflection of what the market's doing. So again, I know that this move, for example, back at 4 a.m. crossed outside of the 2 sigma for that period of time. So it was only a double bar out there, but it sped up really hard and poked up really, really hard right there, harder than it usually does. And then there's other times, if we look on the backside, we haven't really stretched beyond the 2 sigma on the retracement side. So that could give you confidence as far as the morning was concerned that we were still kind of creeping upwards. Oftentimes, that's what people will look for when we retrace. Do we break the 2 sigma, or how far back do we go? Are we retracing to the median, for example? That could be a sign of a really strong uptrend. Oftentimes, a really strong uptrend will do kind of exactly what you saw this morning, where, let me draw in a watercolor. I like to draw in watercolors so you can see the price action behind what I'm doing, because I draw over price action a lot. But this morning, see how we were 2 to 2, and then 2 to 2, and then we went to the median and started to break out the top side of the 2. We went up to the 3 sigma. Oftentimes, that's how a really fast uptrend will start. Back to the median, median, and then that time we broke past the 2, past the 3, all the way to the 4, and on the nose hit the 4 sigma to the tick before we wicked away, and we never hit the 4 sigma again. I don't know that you would set an order on the 4 sigma Bollinger, but this is a time that it became pretty relevant. It hit to the T without going a quarter point past it. After it hit the 4 sigma, it slowed down at the 3 sigma here, the next one inside, before running all the way back down. And that's when opening bell happened. So this is when we have a lot of emotion this morning. But how fast did it go down? So let's zoom in and look at that really quick and see that on the downside, wow, same thing. Broke through the 1 sigma, so it's a fast move, through the 2 sigma, so it's a rather rather fast move, not just quicker than average. Through the 3 sigma tells you it's a really fast move all the way down to the 4 sigma line. And after OB, we actually broke the 4 sigma this morning. And that's where, again, less than 1% of price action will ever be outside of the 4 sigma. So when you see it break the 4 sigma, it can't stay out there very long. Are there times that it does? Absolutely. There's exceptions to every rule, but you're running off statistics, and statistics tell you less than 1% of the time it will even be outside of the 3, let alone the 4. So it's a general indication. You see kind of where I'm coming from with how fast the market has been relative to what it's been doing. And that's important. Bollingers are always relative. There's no way to say, if I have a 3 sigma Bollinger, it's 10 points across, because it's always based on what the price action has been doing and how fast it's been moving. So it's always accurate to the last 20 candles and what's going on now. Whoa, I did not mean to do that. I apologize if anyone's blind. One common way to use Bollingers, people will say, so let's talk about a couple trading setups, and then I'll slow down for today. So, two different things people like to look for. If we're in an uptrend and the Bollingers on both sides, I talked about this vaguely earlier, I didn't mention everything, but if the Bollingers are expanding on both sides, whether it's your 2, 3, and 4, if we're in an uptrend and the Bollingers are expanding, that's a good sign that not only are we in an uptrend, but we're in an uptrend that is speeding up in the up direction. So one trader, Anthony Crudele, as well as many others, including myself, will see this as a big indication to say, not only are we going up, we're speeding up in the up direction. So it's kind of a green light to go long. Says, the Bollingers are telling me, like, sorry, back up a second. I'm stumbling over my own words. I already know we're above the EMAs. I already know we're in an uptrend. But when I look at the Bollingers, I see not only are we in an uptrend, we're in an uptrend that is speeding up in that direction. So that could give you confidence, maybe to even go for a runner type trade to say, okay, we might break this higher high because it's running in that direction pretty quickly, or any attitude you might have. But understanding that when they're spreading out, often traders see that as a green light that the market is not just going in that direction, but going fast. And that can work for the other way too. If you're going down and your Bollingers are spreading out. Basically, if the Bollinger against the trend, if either Bollinger is going against the trend, the market's speeding up. So see how we're in the up direction, and the bottom band, if it wasn't going that fast, the bottom band would be kind of going with it. But in this case, we're saying, wow, the market's rocketing up. So you see your bottom band actually spreading out from that price action because of how fast it's going. And then same thing in the short direction. If you see the market going down, what you would expect is the other Bollinger to be kind of hugging it in that direction if it's not out of the ordinary. But once it becomes a very, very fast move, you see the Bollingers actually spreading out on both sides. So your top Bollinger is going up instead of following the price action down. And that's one thing to point out. And then vice versa, if you think you might be nearing the end of a trend, you might already see the market rolling over a little bit. So a lot of times we talk about the market rolling over when it does something like that in an uptrend. But your Bollingers at that point will go from being really, really wide, maybe even going out, and then they'll start to squeeze back against the price action, and they'll start to squeeze in when the market slows down. So that's the other end of that spectrum that tells you that the market is slowing down. When the Bollingers were expanding in the beginning, it tells you the market was speeding up at that point. But once they start to roll over, you see your top one coming in and your bottom Bollinger coming in. At that point in time, you have consolidating Bollingers. And that might be a sign that maybe I don't want to break a new high in the trade, or whatever rule you might set. But the understanding is that at this point in time, the market is slowing down in that direction. So you might be a little hesitant on your trade. You might take a step back. You might make sure you have enough headroom. You might look for a certain retracement, however you like to look at it. But understand when the Bollingers are consolidating, the market is slowing down in the direction it was going, whichever direction that was. Another common, so how might people trade this? Oftentimes, I like to talk about a couple different trading setups as well. The important thing I wanted to mention a second ago was that when the Bollingers are expanding, oftentimes people are aggressive. If the trend is up, they might be a little more aggressive getting in that trade as an emotional trade because they know that the market is abnormally fast in that direction. So I talked about it being a green light. Green light meaning maybe you're a little more aggressive, or maybe whatever that might mean for you. But oftentimes traders see when the Bollingers are expanding, they might be a little more aggressive in that direction or have a little more confirmation that the market is going in that direction. So that's one thing you might look for with the Bollingers. Another thing you might look for is a 2 to 2 cross. I talked about that earlier, but how do we utilize that in trading? Well, I don't want to say it's almost self-explanatory, but what I mentioned earlier was how the market oftentimes go from two back to the other two, back to the other two, and it's a very common look to see from one 2 sigma to the other 2 sigma. It's amazing to me personally how often that happens. It's awesome because I put on this indicator and you see it the first day and you're like, oh, well, that's a cool coincidence. And then 6 months later, it's like the amount of times I see a common trend, I guess you could say, a common speed of a trend bounce back and forth between either the 2 to 2 or a 2 to the median is very, very common. So I actually have this written out on one of my rule sheets as a rule, as a point of confluence. It's a point of confluence to me if I see a 2 to 2 cross, especially in this case, like if I was looking at an uptrend and I was already thinking where might it turn around, and I know this is hindsight, but you can see the bottom of that 2 sigma, we had a turnaround, and at this 2 sigma, we also had a green diamond. And actually, it doesn't look like either one of them would have stopped out, depending on what your stop was, until you filled. But it's very common to see, especially in an uptrend. Oftentimes, you see a little better trend in that direction. So, say those are my 2 sigma, you'll see it just kind of creeping back and forth in that direction. And every once in a perfect blue moon, you get this retracement that's right at 618, and it also hits the 2 sigma. And that's a really cool look to me. So if I was looking at that on the market, you might have seen a deep retracement or something, and it goes up, goes wherever it goes. But when it retraces, if it comes back right to the 2 sigma Bollinger, that becomes a strong point of confluence for me at times, especially if it fits our PSR. The 30 to 70%, maybe it's around a 50 to 618, because oftentimes it's a deep retracement. But overall, if we're in an uptrend or downtrend, but I see in an uptrend specifically, if it turns around off the bottom 2 sigma or the median of the Bollinger, that can be a point of confluence if it fits with everything else I'm looking at. So if it fits my 30 to 70% retracement, it fits my trend, it fits my headroom, it's a strong point of confluence when I see the market turn around off the Bollingers. And I slow down there for a reason because it's not that it has to turn around there, but if you're already looking for a turnaround and you see something like, let's back up. Either one of these are a good example. See, this one's a 2 sigma. It wicked under, came back above it, showed a 1 2 3 turnaround. That tells you that's as low as it wanted to go. It wanted to turn around there. That's something I might look for at times, as well as something like even the center right here where we see a red down and a green up. That's what many people refer to as a double bar. So you might see the first stage of a turnaround, the next one actually painted a diamond on the next candle. But your point of confluence might be something like here's another double bar where you see red down and green up, and it happens in that case right at the median. Remember, the median is the yellow dots. So I kind of jumped ship there and went to the median of the Bollingers. But we see that there's a double bar at the median of the Bollingers, and that's a very common look. If we go back even further, you see the 2 sigma has a perfect 1 2 3 turnaround happening where the bodies and the wick all seem to get comfortable. So if I clear that, it's way back at 5:30 in the morning on the left side of the screen. We have a 1 2 3 turnaround where I'll just highlight the Bollinger so you can see how it turns around at it, but see how it turns around right at the dots. Never really wanted to be below there at all. Maybe once it closes green, you could say not only is that turning around, it's turning around where it should. And in this case, we're a little bit sideways. If you want to look back on the trend, wasn't a horrible trend. If we talk about points of confluence, we saw a 2 to 2 cross, and then it would have gone up and filled. It actually broke all the way to the 3 there before coming all the way back down, and it didn't close outside of the 3. That's important to note. It didn't even close outside of the 2. So it poked all the way up there almost to the 4 here, but did not like being up there, fell all the way back to the median, and then ended up going all the way down to the negative 2 sigma Bollinger. And once it got there, you saw it turn around right on the bottom of the Bollinger. Not a bad trade if you think, wow, the market just stretched all the way from the top two all the way to the bottom of these Bollingers without really showing a move up or a retracement. So oftentimes that's what people will look for. That's what I refer to as a 2 to 2 cross. Tells me the market is very, very stretched in that direction and might want to rebound back. And if you can match that rebound up with we're in a good trend and that's a 30 to 70% retracement, it's a green light to me as far as I'm concerned. So really cool to see how it goes from the 2 to 2 cross, or see how it stretches back and retraces. One more important thing to talk about, I don't want to drift too far into Bollinger's 202 or whatever, but one thing you might see is see how the median of the Bollingers, oftentimes if the market comes off the top, you might see a retracement at the midpoint, break through the median, and then come back and retest the median. Similar to how we talk about a channel, you might see what was the floor become a ceiling. So any key level oftentimes will become a pivot point, if you will. The median of the Bollingers is one of the strongest pivot points just by nature, just because it's there. So oftentimes I know just because we cross the median of the Bollingers, it might be kind of hard to get back through it. So a lot of times these sideways moves happen on the midpoint of the Bollingers. So if I'm looking at that, let's undo my drawings and just select the Bollingers so we can see where the midpoint is. The middle dots will be the midline. That's why I clicked the outside for. So the midline here is the midpoint of the Bollingers. And what I want to point out is how we'll use them as a floor, trying to crawl up off the midpoint. See how even there you have 2 wicks under, still trying to push up. And then as it turns around, same thing, retests on the other side to push down. So it's common to see a pivot point created out of the midpoint of the Bollingers. I expect rejection there very, very often. And then one last thing I kind of hinted at, but when I see the 2 sigma to a 2 sigma, every once in a blue moon, if I see the confirmation that it is turning around, I'll actually hook an order to that 2 sigma. So I don't like to do it. Let's see an example where that might happen. I don't like to do it on our way down with all the red candles, because that's a scary move. You never know how far it's going to go. It might just go to the floor. But if you see this area where it showed you it wanted to turn around on the 2 sigma, or it shows you a double bar, for example, this one at 3 in the morning is one that would have worked that way. So maybe it shows you it is turning around there. And then the next time you say, well, I don't necessarily like where the candle closed, but if I want to set my order right on the 2 sigma and say, if it comes back to get me, I'll be in the trade. And that's become something that some traders look for over time, including myself. So I'll see a turnaround at a level that's the 2 sigma, and instead of taking the end of the candle, I'll say, well, it's showing me it's turning around, but I want a little better position in that trade. And one way to get better position in that trade is to set your order either on the 2 sigma, or every once in a while I like to do a quarter tick or a half tick above, just to try and get picked up, because oftentimes it will wick to the 2 sigma to a T and then run away without me. It's like it did exactly what I wanted it to do, and I didn't get in the trade. So I know I've been talking rather quickly, but right. So every once in a while, I'll hook an order to the 2 sigma on the back side as a retracement if it's already showing me that it's turning around. Keyword, I don't want to be the person trying to predict the market, but if the market's already turning around at a place I want it to turn around and I can set that order to get a little better position, then every once in a while I might set an order, assuming that I'm more likely to miss the trade, but I want that position to be in it for whatever reason. So this might not be the perfect scenario, but as far as the 2 sigma is concerned, it's exactly what we look for, where we see it was going down and then it turned around and started to show us green. So it's trying to push up off the 2 sigma. Maybe I either don't trust the turnaround, it's not quite where I want it. I can set my order somewhere in that area, a half tick or right at the 2 sigma, and in that case it would have come back and gotten you and then moved forward. Maybe you have an EMA, so maybe what you're seeing is similar to this picture where it's turning around under the 21, but you see your 89 way down there and you're like, wow, that's scary, it could go all the way down there. Well, sometimes if I'm scared of where my stop would be, instead of taking the market where it is, I might look back at the 2 sigma or the 1 or the -3, whichever you choose. Personally, I like the 2 sigma. So I might look back and say, you know, that stop looks scary. I'm just going to take this trade if the market comes back to the 2 sigma rather than take it where it's at, because that's a scary stop. Many traders like to talk about a fundamental change in their trading over time is when they start to worry about their stop more so than their gain. I can attest to that times 1,000. It's like when you worry about what you might lose and then let the market make what it will from that standpoint, more or less build your trade from a stop where you think the market won't go, trading tends to be better over time rather than looking at headroom and saying, oh, that's what I could make. It sounds funny, but it's the natural tendency of any person who's trading to want to look at the money they'll make rather than what they might lose. So a Bollinger is a good way to say, if this is too risky, maybe I want it to come back to the Bollinger rather than where it's at.